Greetings, Jonathan Camarda, as we roll through the second full week of January. And just like we talked about last week, a little bit of a pullback, a little bit more than that. We've seen some rotation out of the Magnificent Seven, the technologies, all the high-flying stocks, into more value-oriented stocks. What does this mean? What does the top-down look like? What are the repercussions? Let's get right to it. So we'll start right with that. Obviously we had technology stocks, discretionaries last year, all of your high flyers that outperformed. And not surprising, as the market traveled to the top of its channel, getting to technicals here, really since the bottom in late 22. And a channel is when the market's basically moving in an upward or downward direction, and then you have prices zigzagging. Imagine a ball bouncing between a ceiling and a floor, except it's tilted. Go back to maybe the Titanic, ship going sideways in a hallway, and just imagine a ball bouncing back and forth. Well, generally the markets trend in channels, and then eventually can break out of that channel based upon either time frames or momentum, catalyst, etc. So the market basically was on the top end of that channel from the low of 22, the S&P 500 I'm speaking of, and has reverted back down. Not surprising. But what are some of the macro pictures that may have been cause of this? Well, we've had rates pick up a little bit, right? We saw jobs numbers last week coming at 216 versus the expected 173, and above the 173 for the month before and above the 175 that was expected. All right, easy for me to say. And then also, again, as we said, rates creeping back up, some hawkish speak from the Fed, right? They always come out of the woodwork like termites, speaking and as such. So you have a confluence of that. Also, as you know, we watch the currencies, the Forex markets, and the market, the dollar market, which was down towards a lot of portion of last year. Certainly the dollar bounced up versus most of its foes last week, versus the euro, the yen, the Aussie, etc. So the dollar going up, rates going up, right? Technologies came down. Again, is this short term? We don't know. But we did talk about the January effect last week. And the first 5 days of January, all right, not be all doom and gloom, can be reflective of the year. So that's why we pay special attention. It's not just a few days. That being said, give a little bit longer historical context. And then we'll get into some of the intricacies and then let you fine folks enjoy the rest of your early January day there. When we start to look at long term, there has been 3 years after a 20% gain for the S&P 500 that we've actually seen 20% gains the following year, only 3. There's been 4 years thus far that we've actually had negative returns after a 20% gain. And don't quote me on this, but it was 62, 81, 90, and 22 were the previous 4 years, obviously 22 being the most recent and certainly the least pleasant from that standpoint. So historically, generally have an up year after a 20% gain in the S&P 500. However, there's no guarantees of that, but only 3 have been plus 20 to match it. So again, most folks within that standard deviation looking for maybe upper single digits this year. But again, those are the same people that predicted another down year last year and a hard recession last year. So we shall see. As we tie it back in, where we're looking at asset classes, rotation of certainly sectors, healthcare, utilities, and as such, more attractive last week. Value versus growth. Which value was on the mat the whole year last year. Growth, and we talked about this beginning of last week. We could see a reversion. Of course, value versus growth last week was pretty attractive. We shall see, though. That's short term, and guess what we have starting this week? Okay, it rhymes with learnings, yearnings. You got it. Earnings. Just when you thought Christmas was over. Only a wonk like me gets excited about earnings, right? Oh, and my very, very much less attractive comrade there, Kramer. Anyway, so when we get to earnings, you don't have the Fed in the way. You don't have interest rates. Big story right now. There's, in fact, this week already they're starting to talk about dampening down, starting to reduce rates. Earnings can take control. And if we have attractive earnings, banks are looking good, your health cares, that could, again, take some traction to the upside. So that's why we don't overreact. This year on healthcare, there's a lot of different things going out with some of the drugs out there and some of the real research on cures for conditions. Again, I'm not a doctor. I just stayed at a Holiday Inn Express last night, and so my prescription's actually in the mail you might need someone to interpret my handwriting now. Should have went to medical school. What? Not smart enough? Okay, well, here I am. I don't know what that says. So until next time, stay warm, enjoy your football, whatever it may be, college or pro, etc. Again, we will remain eternally vigilant as we do watch the markets as I speak right now. We have growth outperforming today, whatever the heck that means. Hopefully you weren't on a plane this weekend. I hate to pick, I'm not going to name individual companies, but that was pretty frightening footage, wasn't it? And the such. Geez, another excuse not to fly for some folks after the COVID a few years ago. Till next time, again, Jonathan Camarda signing off. All right, I think that'll tie this one up for the rest. And stay frosty.